So the recording started, great. The title of the paper is Ambitious, Who Trades Bitcoin Futures and Why. And I just should say that Dimitri said he wants to learn who trades, and we cannot tell you who trades these things. But, you know, we will do our best to give you an idea about, description of how the market is and what the traders look like and all of those things. And hopefully then you will know more than where you started. It's a joint paper with Alex, Amani, and Mike. And again, we are all at the Commodity Futures Trading Commission. For those who don't know, we are a regulator, U.S. regulator of derivatives. So as a result, we get the derivatives data, and then we can look into behind the scenes about Bitcoin futures and who trades it. Before I jump into sort of a little bit of a motivation on this, I should say that it was years ago, maybe it was 2018, that I was at Bank of Canada and a workshop, and I was chatting with some people there. I think it was Christine Parlour, and the Bitcoin futures were got introduced in 2017, late 17, and she was very insistent that we should definitely look into this and write a paper like this. Who trades these things? Who's gonna trade the Bitcoin futures? Of course, back then the market was not developed yet. It was just, and I'll show you some of these things. But 2 years and more after the inception of these contracts, now market is developed and more things are happening. So we figured we should put a paper together. Right. The disclaimer: everything is our fault, and so do not attribute anything to our commissioners or chief economist. All right, motivation. Okay, cryptocurrencies. It's maybe these don't need too much motivation, but let me go through very quickly. So they've been in the news a lot. And especially, I think within the last year, every time I look at the financial news, half of it almost is going to be about crypto assets, right? And some statistics that I found on the internet where top trending news searches of 2021 included 2 of the cryptocurrencies. And even if you look at sort of a Google searches about where to buy, half the searches, top searches, are going to be about cryptocurrency queries, right? So people think about it, people are writing about it, and I'll show you some people are investing in these things, at least the derivatives of this. So it is a very timely topic in my mind. Okay, so there are a lot of cryptocurrencies out there, and Bitcoin is not necessarily the new cool asset in town. We know that, but we still know that people do trade or use a lot of Bitcoin in the world, and there's actually a great paper on that in terms of the use of cash Bitcoin. But we also happen to have the data on the Bitcoin futures. So for us, that was a no-brainer in terms of looking into this market. A little more motivation, if you're not convinced with the previous slide, is, anything with a price volatility or a price increase and a dip, another increase like this, I think is going to be interesting, and people are going to be investing in something like this. So speculation, or whatever you want to call it. So for us, this is also interesting. It's not a sleepy market for that matter. Why Bitcoin CMEs, Bitcoin futures? Okay, so we do focus on BTC or CME Bitcoin futures. One, because it was introduced in late 2017, now we have good amount of data on this. And 2, it is the biggest regulated Bitcoin futures contract. Okay, I'll show you some stats in comparison to other Bitcoin derivatives, but this is the biggest in terms of regulated. Well, what that allows us being a derivatives regulator, is to look under the hood to see who is trading this contract. And towards the end of this work, we also talk about micro Bitcoin futures contract, right? So that was introduced in May of 2021, and that contract also grew quite fast. And we also take a look at it just sort of for completeness purposes. Okay, so how does the market look? Well, it's really busy, and this is from CoinGlass, but I'll try to walk you through. So I'll tell you that, again, Bitcoin, CME's Bitcoin futures is not the biggest one in terms of open interest, right? It is actually Binance Bitcoin perpetuals. However, you will see, I mean, it's a little hard to see, I know, but all the way at the bottom, kind of the darker blue one, that is actually the Binance. And this lighter blue is Bitcoin, CME's Bitcoin futures. So if you look at sort of numbers, it is second in terms of percentage of open interest. So it's not, it's not the biggest, but it's definitely sizable enough that we think understanding trading in this market matters for us understanding how people trade Bitcoin derivatives. So what are we looking at here? A little bit of a background. So Bitcoin futures, again, was introduced in December 18 of 2017. It's not the first one. Some of you might remember that there was another Bitcoin futures that was introduced, I think almost exactly a week before the introduction of the CME's futures contract. However, that one folded, I don't know exactly, but within 2 years, maybe even quicker than that, sooner than that, it folded. So that's why we focus on CME's futures contract. Contract size is 5 Bitcoin. So it's not small. And the threshold for reporting, and I'll get to that in a second, that's going to be important, is 25 contracts. So if you multiply with 5 Bitcoin, it's 125 Bitcoin. So, depending on the price of Bitcoin, we are talking about a sizable investment in this case. And for micro, which we will touch upon at the very end, well, contract size is 0.1 Bitcoin, so considerably smaller. And the problem is, which is obvious, is going to be that, well, it was introduced on May 2021, and our sample goes till September 21. So we only have a handful of months to even look at this. So whatever I say about micro, I mean, you can feel free to take it with a grain of salt or ignore it because we don't have enough observations. But I will show you that even that market got liquid enough rather quickly, which is, I think, a quite good success for the CME. And the threshold for reporting is 25 contracts, which is 2.5 BTC. So in micro Bitcoin futures, we will see more people reporting and maybe potentially different kinds of traders reporting. Okay, so the data here's the important bit: end of day positions of large traders in BTC and micro BTC. What do I mean by large traders? I am pretty sure most of you have used our large trader reporting system or the COT, right? Commitment traders. And all of those are based on the large traders that report to the commission, to CFTC. So again, every commodity has a limit. And if you're holding above that limit at the end of the day, you have to register with us and you have to report it to us. And as I just showed you earlier, right, for this limit for the regular Bitcoin futures contract is 25 contracts, which is, rather large, but it's quite smaller for micro Bitcoin futures. And you can trade, again, if you're trading less than this amount, and if you end the day with enough contracts that are less than our reporting thresholds, you don't need to report it to our end of day as a large trader. So you can, if you want to say, fly under the radar, and we do see people doing that. Data, again, it started trading in December 17, and we ended up our sample in September 2021. And it's important to say that we didn't do it on purpose, but our sample does end before October 19th, 2021, which is when the ETF that's based on Bitcoin futures starts trading. And maybe that's a different paper. We might look into sort of how that's affected this market, but at least our findings are not impacted by the ETF that's that's actually the ProShares ETF that start trading the Beetle. We have the data to actually go back to 2002 and ask, whether some of the traders we see trading these Bitcoin futures, were they always traders? Were they traders 15 years ago as well? And I'll tell you that why that's going to be important. And eventually, we do use publicly available daily prices for some Sharpe ratio analysis, which is, I don't know if anybody's looked at the paper, but it's not in the current SSRM version, this very last analysis. So it's a little bit of a new analysis that we're going to present. Just to give you an idea what happened in this market. Well, as you can see, the left-hand side, this is the open interest. And open interest was normal levels, I would say, 4,000 contracts, 2,000 contracts, somewhere there after it started. But something happens in mid-2020, and then things start going up. And this is going to be important that we actually divide sometimes our sample for before and after mid-2020. And I'll show you what types of traders actually come into the market, which might have caused this, or which might have come into the market because suddenly there's a lot of open interest going on, and CME Bitcoin futures is growing in terms of importance. And if you're curious about the price, just putting in here that it went up and then came down and increased a little bit again. Okay, so I'm pretty sure I'll finish in time, but in case you have to leave, main findings. So what we see is that the market participants in Bitcoin futures falls mainly into two categories. We divide them into three, and I'll explain why, but it's really, the important thing is they are concentrated. They're traders that hold concentrated portfolios, right? So their portfolio is concentrated around this Bitcoin futures contract. And they might have some other positions, but they're going to be minimal. Or we see these diversified traders holding diversified portfolios where Bitcoin futures is only a small portion of their portfolio. And we do think that these are two different kinds of traders, these with different sets of goals. Again, as I mentioned in the previous slide, mid-2020, it seems like the market has shifted a little bit, right? And what I'll show you is that after mid-2020, the bigger portion of the open interest is being held by these diversified traders, or traders with diversified portfolios. And this is especially true on the short side, right? The short futures, those are much more populated by these diversified traders. Something else that we show is many of the long participants, those are holding long futures, are not reportable under our rules, means that they are flying under the radar, if you will. So we infer, again, we're not showing anything, we guess, we infer that these must be small, maybe retail-like traders, and that are going long in this contract. Again, we're not, take that with a grain of salt because we don't even have a definition for a retail trader, but we think they are small traders. We do show that there is room for this contract in some sort of like a theoretical optimal futures portfolio, if you will. And we compare what the optimal ratio of this contract in a portfolio, and then we compare it to what actually traders hold. And we see that depending on if you look at it, traders could use holding a bit more of this contract. And finally, we looked at the micro Bitcoin contract futures, and we'll show you that the kind of the composition of trades is a little different. But one of the other questions we were curious about as well, okay, so here comes this micro contract, and does it really steal some of the traders from the Bitcoin contract? And we don't necessarily find any significant indication that traders are migrating from one contract to another. And I'll show more. I'll tell you more about it in a few slides. Okay, so literature review. So a lot of the literature that I've seen has been more or less about where is price discovery happening, right? So is BTC futures leading or CME's Bitcoin futures leading prices? And some research shows, yes, they are. And surprisingly, using similar data, other researchers are showing, no, that's not the case. And it's Bitcoin spot markets. And Carol Alexander and Peck have a paper where they do an interesting horse race where they do a horse race across futures contracts first and across cash contracts. And then they try to see which one is leading. And they actually come out to say it's not CME futures, but it is Binance perpetuals that lead price discovery. Patrick has, with his co-authors, has a very interesting paper looking at the impact. They look at at the inception of this exact contract we're studying here, and they look at how it impacted the cash market, and they find very interesting results about increased synchronicity and that it improves the cash market. And maybe the closest to our paper, while not in Bitcoin derivatives, is Makarov and Shore, where they look at the cash Bitcoin holdings, and they find it to be, they found a lot of things very interesting. But one of the things that's maybe relevant to our results is that they find cash Bitcoin holdings to be highly concentrated. And we do find some concentration in the futures, Bitcoin futures market as well. Okay, so let's start with part of the title: who trades Bitcoin futures, right? Now, again, when we looked at the traders in our data, and we want to see what percentage of their portfolio is made out of Bitcoin futures. And this graph here is actually, they're kind of the average across all our sample. And the first thing that struck us was, why is this bimodal, right? So we see a big spike around 0 and a big spike around 1. So 0 just meaning that they're holding, whoever those traders are, who are holding very small percentage of their portfolio is Bitcoin futures. And 1 means there are traders who are holding only Bitcoin futures, or Bitcoin futures plus minimal other futures contracts in their portfolio. Again, I should give the caveat that we're only looking at futures portfolios, right? So these people might be holding cash. We do not see their cash holdings, so I can't say necessarily they're, even those that are around 1, the spike around 1, I can't say they're only holding Bitcoin futures, because they might be holding cash in other assets. We don't see any of that. This is all about their futures portfolio that we can see. So we do see around 600 unique traders who report BTC positions. And again, these traders are not always in the market, right? In this beginning of the market, I'll show you next slide. There were a number of them, and then more come into the market and they drop off the market. So they come and go. And then to sort of talk about this, these two types of traders, what we did is we actually coined them or named them as concentrated and diversified traders, or those with concentrated or diversified portfolios. And we were quite lenient in terms of our definition, right? So what we said is, okay, any trader who's holding 20% or less of their portfolio is made up of Bitcoin futures, we're going to call them diversified. And if the Bitcoin futures in your portfolio is 80 to 100% of your portfolio, then we're going to call you concentrated. Anybody else in between, we're going to call you hybrid. And then we do allow these labels or traders to come in and out of these groups, so they're not very strict. But what I'll show you is that we could have set more strict boundaries, and I think our results would have still held, because when they are concentrated, they're very concentrated, these traders. When they're diversified, they're very diversified. And finally, this bimodal distribution we see, you could ask yourself, okay, well, we don't know, but isn't every market like this? Or we don't know what the markets look like, other markets look like. And Well, to get an idea, we just did a quick, we calculated cortezes of the end of day positions of different traders for 250 markets that we see, the top 250 markets. And what you can see is the mean is about 7 and BTC is -2, indicating very fat tails. And it is much more bimodal than, if you will, than all the other markets we see. It's not the most bimodal one, but again, in terms of distribution, we didn't do a t-test, anything like that, but it would be pretty significant. Okay, sorry, this font seems a little small, but let me walk you through a little bit of this. So we were curious what the sizes of these traders are. Now that we've defined them, how much are they holding, and what's the size of their portfolio, what's the size of their Bitcoin futures holdings. And we picked 2 random dates, one in June 2020, another June 2021. So the first 2 columns are June 2020, June 23, 2020, and the second 2 are about a year after that. And first thing to note is, okay, so at any given day, there are not a whole lot of traders, right? There are a lot of traders in our full sample, but for example, in this day, there were only 43 concentrated traders, and a year later, it's only 36 concentrators. So, and again, keep in mind that traders might still be trading, but these are the large traders, the ones that are holding 125 Bitcoin or more. And their mean, so everything is in dollars, in this case, by the way, and we look at their net portfolio, and their mean is about 7.4 million, and net BTC in this case is about same 7.3. Right, so this is the concentrated group. So their concentration is very high, and actually, if you look at it, it's about more than 99% of their full portfolio is made of this Bitcoin futures. That's that, and I didn't do them. I'm not showing the following year, but it's, again, I think it's at 89, 88%, so it's still high. And we moved on to diversified traders, and you see suddenly it's less than 1%, 0.2% for 2020. But let me take these out. What you see also is that diversified traders is actually much larger. I mean, their net portfolio is larger. That makes sense. But even their Bitcoin futures holdings are about 1.2%, or about 20% higher, maybe, than those we see on average from concentrated traders. So they're not a lot of them, only 29, but that goes up to 62 in a year's time, and that, you know, is an important clue about what's happening to these markets after 2020. But in general, they do hold more Bitcoin contracts than concentrated traders, even though it's only a small portion of their portfolio. And then the rest is just, we get, you know, hybrid traders. They're not as many, and again, some of these groupings are flexible, so they come and go. Okay, so how did the market evolve in terms of number of traders and in terms of these trader types? So here, you know, for color coding, blue is the concentrated traders, orange is diversified, and green is going to be the hybrid or hybrid traders. And, you know, if you just add these things up, you'll see, you know, market starts with about 45, 50 traders. And by the end of our sample, you're looking at 140, 150 traders. Again, at any given, these are 6-week intervals. So at any given 6-week interval, that's how many unique traders we see, unique large traders we see in this market. And you can see, you know, that there is growth, which is normal, right? Was more as the contract picks up, people hear about it, people start trading it. But there's a little bit of a maybe steady state happening till about mid-2020, and then there's more interest. So first clue maybe is that more traders are coming into this market, more large traders are coming into this market after mid 2020. Suddenly there's more interest. And if we're not doing ratios, but if you could eyeball the ratios, you would see, the last 4, 5, 6 months of our sample that orange is constituting a bigger portion of these number of traders than the other two, and orange is the diversified traders. And that only happens, again, towards the end of 2020 and after that. So that sort of was our first clue that maybe something's changed in this market starting about mid 2020 to late 2022.
Let me jump in and ask a question. First, I'll ask a clarifying question.
Yeah.
So these concentrated traders, right? Some of them are long and some of them are short. This is just the sum of the absolute values of their positions?
This is just the number of unique traders. This is the trader count. I will show you their longs and shorts separately in a few slides, actually.
Okay.
Any other questions? Okay. The next question was, we're really curious. So let me go back to this slide for a second. Okay, so here the market starts, right? This is the inception, and I see at least at the start 50 traders and overall 600 traders in this market. Well, the question we asked ourselves was, are these all new traders? Did they just come into this futures market just because to trade Bitcoin futures? I said, hey, there's a regulated futures derivative, regulated Bitcoin derivative, let's go trade it. Or were there already existing traders that were in the market and they said, okay, I'll consider this, I'll add this to my portfolio. Well, the graph is a little bit of hard to read here, but what we did is, because we have trader IDs that are kept throughout time, we went back to 2002 with the trader IDs. Now, let's look at orange, which is again the diversified traders. So we do find that out of, let's say, 160, 170 traders at the end of our sample, about 30, 40 of them were still in the market in 2002. The fact that it's got a positive slope is just by design, because we would expect somebody who's in the market in 2021 to be also in the market maybe in 2018, but maybe not in 2002. So the closer you are to our sample period, the more likely you're going to be in the market. So the slope itself doesn't necessarily tell us much. What tells us much is actually this kink here that we're interested in, because this kink corresponds to inception of the Bitcoin futures contract. And after that, suddenly this concentrated traders, their slope just jumps up a lot, and suddenly we see more coming into market. So there's a whole lot of people here, traders, that were not large traders in any contract that we can see across. This is even including other exchanges, ICE, for example. They were not in the market as large traders going back to 2002. So we definitely have people, we believe, that came into the market to trade this contract. And we definitely have traders who were around and who stuck around and who just added the contract to their portfolio. And in a way, this gives us hope that our definition of diversified and concentrated traders makes sense, because we would expect to see concentrated traders to come in just to trade this, because they almost only hold that contract in their portfolios. Okay, so now coming to Neil's question. Well, we talked about number of traders, and now they're split across these three categories. How about open interest? What percentage of open interest is held by these different types of traders? Now, again, going with the same color coding, except now we have a new color here, which is red, which is the non-reportables. Again, remember I said you have to be holding 25 contracts to be reporting to us to be a large trader. Otherwise, you're flying on the radar and you don't need to report. Well, how do we know what percentage of these people are flying on this radar? Well, we know the total open interest, and we know everybody else and their total open interest who reports to us, the large traders. Whatever is left is going to be the non-reportables. And again, non-reportables group here is quite interesting because a lot of times, and other studies have shown that non-reportables group doesn't tend to be this large. They can be, 10%, 5%, 15% max. But what we see here is that this red group is quite large. At some point, it's, I think, 35% of open interest, or maybe even higher. So it is possible that there is a lot of small traders that are not large traders, but they're still holding a third of the long open interest in this market, which is not something we see in other markets. Now, the green, which is the hybrid, again, it moves up and down from time to time, but it's somewhat steady. And we tend to see, at the early stages, concentrated traders seem to be holding more of the open interest, and then maybe towards the end, it's a little more diversified traders. But maybe no group is really dominant on the long side. Now we do the same analysis for the short side, and a number of things come up, right? So first, the red, which is the non-reportables, that's what we'd expect. We'd expect it to be about 10%, 5%, 8%, and that's what we see. Again, these are, I think, 6-month averages, but that's what we see from 6-month averages. And this is comparable to corn, soybean futures, butter, and other futures you can think of. Then we see this increase in orange, which is the diversified traders. Again, something that lines up with, the late 2020, suddenly there's more interest, and we do see more diversified traders coming in.
So am I correct to interpret this so that the diversified traders have a net short position because they're a much larger fraction of short open interest than of long open interest?
In net, I think that is true. They are, but again, it depends a little bit on, like, if you take the average, I don't remember exactly what the average looks like. If you were looking at 2019 to mid 2020, they are a much smaller percentage of the short.
Okay, just at the end, right? Just so I'm interpreting.
Yes, yes, at the end, you can say that they are short. Yes, that is correct. And again, it is so. I showed you that new traders came into the market in terms of large traders. That is true, but I do want to also give a caveat about this, especially toward the end of this graph, which is that there is movement across these categories, right? They're not rigid, so it could be that some of the concentrated traders decide to hold other contracts and they suddenly became diversified. But I mean, we do tend to see that there are more also new traders came into town. So we think it's a combination of some of these things that a big portion of the short open interest was suddenly composed of diversified traders. Okay. I'm sorry, I did that. Now, the next question we had was Bitcoin futures, an interesting contract. Bitcoin, I mean, we can debate whether Bitcoin has any fundamentals. Some people think of it as the new gold. Some people could think of it as just another currency, but it's a little, I think, nebulous what Bitcoin is going to be affected by. And instead of thinking of it as, okay, so if I'm holding Bitcoin, what other contracts I should be holding? What's my best bet? Anything like that. And again, as I said, there's a bunch of different papers on whether Bitcoin is the new gold in terms of hedging. What we wanted to do is let the data tell us, right? So we looked at our traders, but mainly diversified traders because they hold a lot of other contracts, and we thought, okay, so let's assume that Bitcoin futures is connected to other futures markets through these common traders, right? If I'm holding Bitcoin futures and I'm also holding WTI or oil futures, then maybe I am the trader or traders like me who are connecting these two markets. So can we think about how connections between markets through common traders? And if we can, then how does Bitcoin futures connect to other markets that we see in our sample? Now, we found a measure, Anton Polk, from Anton and Polk for 2014, which really worked for us in the sense that basically what we can do with this measure, and when we apply it to our setting, is we take the dollar value of the contracts held by trader I on time T, and again, these are the Bitcoin contracts, and we're agnostic whether you're long or short as long as you're holding it. And we add the contracts also held by trader I at time T of different contracts. In this case, I'm just giving an example, so it could be gold. So I'm looking at trader I's contracts, dollar value of his contracts in Bitcoin as well as gold, and I divide it by the dollar notional value of the open interest in both markets. So that kind of get a ratio, sense of ratio. Again, you know, I sum it for all the common traders that are between these two contracts, and we do it for all the contracts. I think all the 250 contracts that we look at, try to get a sense of which markets are connected to Bitcoin through common traders. And a few things. So one, this also allows us to do some sort of a trend, right? That the connections between Bitcoin and other markets change throughout time. And how strong were these connections? So we were hoping to get an idea of how other markets are connected to Bitcoin. And it's a little hard to do a time series, and I'll show you some time series, but for every contract. But what we want to show is that how about we take top 5 as our connection measure, Anton Polk connection measure indicates, and we look at them for each year. So we run it for each year across 250 contracts and to get our top 5. I think this is very interesting in terms of the pattern it shows us. I mean, first of all, what we see is that there are common contracts, especially for years 2018, 19, and 20. We left 17 out because it was only like less than a month. For these 3 years, the common contracts we look at are gold, crude oil, S&P E-mini, and silver. Now, give and take, because the first year, again, the other, I think it was CBOE, Bitcoin futures was also being traded. So in the first year, you see that it's also those who hold CME Bitcoin are also holding, some of them are also holding CBOE Bitcoin. But after that, it drops because the contract folds. And then what you're left is in 2019 and 20, interested in the same set of other contracts. So gold, E-mini, crude oil, silver, and nat gas, natural gas. And these numbers also tell you kind of how many traders are common between these two markets at any given year. Something else that's interesting happens in 2021. Suddenly our markets change, the connections change, right? So first we have new markets that are coming in. I forget exactly when Ethereum futures came in, but it comes in, and we also get micro Bitcoin, which is coming in May of 2021. And people are also ditching, apparently, in terms of common traders, ditching E-mini, but taking on NASDAQ 100 stock E-mini index. And copper comes into our top 5 as well. And the only top 5 contract that sticks around is gold futures. So again, this is just one way to connect markets by using common traders. Doesn't mean that the returns of these markets were necessarily the same or anything like that. But we thought it was interesting to see what the diversified traders that are holding Bitcoin futures were also holding in their portfolio. And they were, what we find is that they were pretty consistent till about 2021. And then there was a little of a reshuffling of their portfolio and the contracts in their portfolios. So, and if you're curious about a little bit of a more time series, so I could show you a few here with selecting two contracts, right here, Bitcoin and gold, just because gold is always compared. And on the bottom, you get Bitcoin and WTI. And again, I described the ratio, but the ratio about 5%, 6% is quite steady up until again mid 2020 or late 2020, and then it starts picking up. There's more connection between these two markets, and we see the same pattern in WTI. Again, the connection is little lower at the beginning of our sample, but then it does pick up within the basically in 2021 it does pick up and considerably goes up. And if you look at E-mini, same story, right? But except the jump is bigger, right? You go from 3% from our using the on-top pulp measure to about 20% jump in 2021. So we find this interesting that, again, either traders changed what they were holding, their portfolios, what they want to hold in their portfolios, or maybe more like the more people came into the market that had different goals in terms of what they want to make hold in their portfolios, and maybe they were the ones who were causing this increase in the common measure, on-top pulp measure.
So in these pictures, pictures in the on-top pulp measure, you're selecting the contracts that had the highest value of the measure in 2021?
So let me go back. For each year, like for example, 2021, we are selecting the top 5 that had the highest value. And which is interesting because our time series, we did it for those that were more dominant in our sample, stuff like E-mini, crude oil, gold. And we didn't even include the others because the sample would not be that long. But what we see is even E-mini, which drops out of our top 5 in 2021, increases by a lot in 2021. So we could, it would be a much shorter sample. We could do, for example, NASDAQ mini or Ethereum futures. And I think the AP measure would be quite high for that. This is all sort of a different ways, I think, in my mind, of looking at the fact that something changed in the market. And in a way, Bitcoin futures, if you will, got more integrated with other futures markets somewhere in late 2020 and in 2021. And people are holding more of it in their portfolios. So far, I tried to show you who trades Bitcoin futures. And I guess I should also add why, because that's in the title. And why trade Bitcoin futures? So, our two main groups, concentrated and diversified. So concentrated traders, I'm not sure there's how much to say there is about them, because they come into the market with the inception of the contract, most of them, and they're holding most of the Bitcoin futures and maybe Ethereum on the side and a few other things, but they're mostly trading to hold. They come into market to hold Bitcoin futures, right? So speculation, whatever it is, or they're hedging maybe their cash positions, which we don't see. So I'm not sure there's much we can learn from their data. So instead, what we wanted to do was turn our attention to the portfolios of the diversified traders. Mainly, we want to ask the question, well, is Bitcoin a great asset or a great contract to hold in your portfolio? Now, what we did is, this is a little bit of a shortcut, but we want to take a look at the contracts that I've just shown you, the top 5, right? The E-minis and the gold and the WTI, and add Bitcoin and make 6 contracts. Out of those 6 contracts, what would I do optimally? What would be my weight for Bitcoin futures? stay in, should I go zero? Should I go negative, positive? What should I be holding? And to be able to do that, so we first we create the efficient frontier for it can be construed from using all of these contracts. And then we ask the question, well, which one of these is the max Sharpe ratio portfolio? So just to note that this red all the way up here is actually the Bitcoin futures with the highest return and the highest risk. And then the Sharpe ratio or max Sharpe ratio is this black portfolio a little above the inflection point. And I want to include this because this is basically this colorful chart is one of my co-authors did, and I just thought it looks interesting and colorful. It's actually the same information that you're seeing in the efficient frontier. There's not much to it other than you can see that depending on different weights for each different contracts, and again, Bitcoin is here is red, that you can get different kind of targeted returns out of this. And I think the black sort of the max Sharpe ratios ends up being somewhere over here, which tells us that, you know, Bitcoin contract, you do want to hold positive amount, or we go long a Bitcoin futures contract, but and not a whole lot. And to put it in easier to read terms, here's a table for it. So we did it for different years. So we did it for the whole sample. We did it for longs only, but if you were just long. We did it for separately for each year, except 2017 again. And we did it before mid-20 and after mid-20, just because market seemed to have shifted. But I'm just going to sort of focus on all of the years, our full sample. And what this is telling us is that, again, in this hypothetical portfolio that's composed of these 6 contracts, futures contracts, there is room for Bitcoin futures, that I should be going long. About 8% of the contract of the portfolio should be Bitcoin futures, is what we see to get the max Sharpe ratio. Now,
so can I ask? So
yeah.
You have said this. So how do you estimate the expected returns? So this is just the mean variance optimization, right? So where do the estimates of expected returns come from?
We're just using past returns as expected returns. So this is all, we're just using publicly available settlement prices and creating returns from settlement prices and using it for each year separately or the full sample. And similar for variance. Now, so it's a very simple exercise. So I won't go back to previous slides, but one of the things was that I showed you the top 5 contracts changes in 2021. So, and they're not necessarily presented here. So we figured we should also do the same exercise for 2021. And again, 2021 had, you know, Ethereum futures, gold, NASDAQ, copper, and Bitcoin, micro Bitcoin, which we didn't include because it would be linear. But if you do look at just 2021, which is a shorter sample, you still see that Bitcoin is going to be in the sample. But if you look at the full set for all of the 2021 sample, you'll see that it's got a negative weight. So, and that's potentially probably because Bitcoin is going to be positively strongly correlated with Ethereum futures, and then maybe to hedge that, you're going to go short on Bitcoin futures. And then what we did, what we did was we said, okay, we got these hypothetical theoretical weights for some optimal portfolios, and how do they compare to what we see in actually what's held by diversified traders? And again, this is sort of more comparable to the table I showed just 2 slides ago with long only or average portfolios for all of the traders. And if you remember, I said for all traders, again, using WTI, gold, and E-mini, the optimal portfolio was about 8%, included 8% of Bitcoin futures. And what we see for all traders is about 2.5%. So it is possible in this simple exercise, maybe to claim with a lot of caveats that okay, BTC or Bitcoin futures might be a little underrepresented in the full sample in terms of what people held. And again, people's new traders came in, and I'm sure more diversified traders came in after 2020, and their needs for Bitcoin futures might have been quite different. But just sort of looking at the full sample, we see that they maybe should have held more. If you focus on in 2021, and if you remember, it was a short, the optimal weight was a negative weight. But in 2021, what we see is that people are holding a positive 1.5%. Their portfolio is Bitcoin futures. So maybe it's overrepresented, or the fact that it's long maybe is not optimal in this simple scenario. Okay, so the final chapter is about who trades micro Bitcoin futures. Right. So far we only talked about Bitcoin futures, which has the lion's share of the market in terms of open interest, trading volume, and whatnot. But in May of 2021, we had a newcomer, which is this micro brother. And here's interesting. So again, short sample, take everything with a grain of salt. But one thing I'll show you is that this is open interest. Now, because the contract size is small, right, I need to hold a lot of the micro BTC contract to even compare to one contract that I'm holding in a regular Bitcoin future. So it's the open interest in terms of contract size, number of contracts is going to be elevated. However, even then, what you see is that it takes weeks for it to jump from inception to about 35,000 contracts of open interest. So there's been a lot of exchanges introduce a lot of contracts. Some of them you don't even realize because you never see, because they never take off. And it's not very often that the contracts are that successful. And actually, Gerd Roviner has a great paper on that. But this, I would say, it's just my opinion, that is one of the more successful contracts that I've seen, that in mere weeks that it goes up to 35,000 open interest. So again, take a grain of salt. It might, everything I'm showing might change or might be different right now, but it's a short sample. But we thought it was interesting that it picked up, and it maybe stabilized around 25,000 contracts, which is still quite sizable. What if we apply our trader categories to the micro contract, right? Again, what we see is most of the number of traders that we see observe in the market are dominated by blue, which is the concentrated traders. And there's a little bit of hybrid, and there's a little bit of diversified. It's number one. Number two is that, similar to the open interest, it takes about 2-3 weeks for for the number of traders to come to some sort of a steady state, which is about 140, 150 traders currently trading in the market any given day. It doesn't take that long for them to flood the market. Now, the important thing here is that the number of almost 80, 90 traders, concentrated traders, the question is going to be, of course, what percentage of the open interest do they really make up? And I'm going to tell you, not much. When we look at these concentrated traders, what we see is that they are a much smaller percentage of the long, and it's going to be the same for the short open interest. You might be wondering, where did greens go? And in this setup, because of the number of traders that are behind all of these numbers that we're putting out, and if there's a small number of traders, then there are some confidential issues that comes in. So in this case, there were not enough traders for us to show the green, which is the hybrid. So we actually rolled hybrid into concentrated traders. So in this case, this blue is even concentrated traders plus hybrid traders. but most of the open interest is held by diversified traders in the micro Bitcoin contract on the long side. And non-reportables may be similar to the regular Bitcoin contract, futures contract. Is a little high. I mean, at times it's about 20%. So we do see a little bit of a still flying under the radar traders in this market as well. Again, the reporting limit is quite low with the micro contract, but still there are people holding less than 25 contracts. If we look at the short side, and I think this is again mirrors what we saw and in the big Bitcoin futures contract, is that a huge portion of the market is diversified traders on the short side. And again, very little concentrated traders and very little non-reportables. So who's holding the shorts in the micro Bitcoin futures? Well, it is those who are diversified, who where micro Bitcoin futures makes up only a very small portion of their portfolio.
Let me interrupt one more time and ask you that it makes sense to start thinking about finishing up in a couple of minutes.
Great. I will. I think I have 2 slides left.
Okay.
Thank you.
Perfect.
Great. Just to, again, mirror some of the analysis, when did these people come in? Well, again, look at this kink. I mean, that there's a huge kink in this blue group, which tells us that the concentrated traders came in, but that mainly for trading micro Bitcoin futures. We do see this in hybrid too, so maybe it is right to roll hybrid into concentrated traders in our case. We don't find that significant evidence that micro Bitcoin contracts took away some of the traders from large contract. You could see that there's a little bit of a kink here. Maybe it indicates, that might indicate a little bit, but again, it's not a huge portion of the traders. All right, to conclude, we had an interesting, unique data set with trader identifiers, identities, and we want to explore this in this very interesting contract, futures contract. And what we found is in this Bitcoin futures market, it seems like market participants are bimodal, that we've got our concentrated traders and diversified traders. And the trader composition and the market itself a little bit, even the open interest, seems to have shifted around mid-2020 or a little maybe late 2020. And we asked how Bitcoin futures connected to other futures markets through common traders. And we saw that it was, a lot of times it was WTI or E-mini or gold. And even that has changed in 2021. Our simple exercise indicate that there might be a room really for Bitcoin futures for in an optimal futures portfolio, that the traders are coming in, diversified traders are potentially, that's what they're doing, diversifying their exposure. And micro Bitcoin contract is a successful contract. It took off, and maybe there should be more, people should analyze it more, but we didn't necessarily find strong evidence that it stole away some of the traders. So that's why I'm calling it, it's got its unique set of traders, it seems like. Okay, thank you very much for listening.
So thank you. At this point, we'd like to invite anyone who wants to unmute yourself and use your microphone to ask any question that you might have. Okay, while people are thinking about their questions, I'll repeat a couple of things from the chat, which I thought could wait to the end. So Dimitri asks or makes a comment that this structural break in investor portfolios in mid-2020 is very interesting because it almost coincides with the break in BTC and SPY correlation, which increased sharply from 0 to 0.3 in March 2020.
That's a very good observation. Yeah, thank you, Dimitri. We'll definitely look into that. And again, we don't want to make any I mean, we can't make any causal arguments, anything like that, but we can definitely list it as an interesting observation right around the time that we're seeing.
And then another, well, let me ask you another question from Dimitri. So is this concentrated versus diversified investor classification a proxy for investor size or the likelihood of being an institutional investor?
I mean, I showed you some of the sizes in our groupings, right? So that the total portfolio size of diversified traders is much bigger than the total portfolio size on average of concentrated traders. So whatever it is that whoever they are coming in and they're holding a lot of E-minis and WTIs, but this is just a small portion of them. I mean, we can't necessarily reveal their institutional traders or anything like that, but this is the closest we can come to saying that they are in it just to add a little more, a little exposure to their big, large futures portfolio through Bitcoin.
Okay. And then another question. Do the data exist to do similar work for another, digital asset class?
Another digital, so something like Ethereum futures,
Yes.
I assume? Yes, I mean, the data is there, and I haven't last checked how big that market is. And again, as I told the story at the beginning, the reason we didn't write this paper 2 years ago is because we didn't know where the market was going to go, and whether it was going to be important enough or whether the contract was going to die. And but it is very simple. It is very easy to do the same analysis for Ethereum futures or any other contract that CME or any other exchange can initiate.
Okay. Are there any other questions? This is a shy group today.
Hi.
I wouldn't have expected the Bitcoin audience to be so shy.
Hi. I'm not shy, but I might have a dumb question. Keith Lewis here. Thanks for a very informative talk, Esen. Much appreciated.
Thank you.
I'm wondering, does the CME have agreements in place with liquidity providers?
That's a good question. As far as I know, and I might be wrong, but as far as I know, at the very beginning of the contract's initiation, right, they might have agreements with market makers, liquidity providers. But unlike exchanges such as Eurex, they don't necessarily have market makers in the contract once it reaches a certain amount of liquidity. Now, that's not to say that they don't give any incentives, right? There are definitely trading incentives, such as if you're trading above certain number of contracts per month, I believe that's how they calculated, you will get a reduced transaction fee. So a lot of market makers, as we know them, principal traders or HFTs, whatever you want to call them, actually benefit from that kind of a reduced transaction fee. But it's not, I guess one important thing is they don't have the obligation to make markets like other market makers in different exchanges actually have.
This causes me to ask a question about liquidity provision. So if a liquidity provider ends up being long Bitcoin futures, how can the liquidity provider hedge that exposure? Is there a developed market for shorting Bitcoin?
That's a good question. I'm not sure if you can. I think you can short. Okay, I should be careful what I say here. I think a non-US person could potentially short using perpetual futures, if I'm not mistaken, and I might be mistaken this because I haven't studied that market as well. But there might be, for a non-US person, there might be other ways of hedging their long exposure through Bitcoin futures, but that wouldn't apply to a US person.
Okay, I was just curious about that.
Yeah, and frankly, my co-authors might have more information, in-depth information about this. And we might we'll get back to you on that, because I don't want to, I don't want to misdirect you on that.
All right, there was another question in the chat. Do you know, or can you infer whether your traders are mostly institutional, large retail traders, proprietary trading firms? Do you know anything else about them? I'm guessing the CFTC does. Are you able to tell us?
I do know, I do know roughly what kind of firms, traders they are. And all I'll say is, just like any other market, we see retail traders, we see individuals in this market, we see hedge funds in this market, we see larger bank like entities. I can tell you that. I can't tell you what percentage of the market is dominated by which type of traders, unfortunately.
Other questions? It's your chance to tell Esen he's completely wrong. Last chance. I see the acting chief economist is also on the Zoom. You can tell him he's completely wrong if you want to.
Oh no, he's not on this paper, and this everything again.
I want to ask a question.